Hi, I'm Paul Merriman, and I started the Merriman Financial Education Foundation just a little over, I guess, 11 years now. And the focus of all of our work is about helping you, as the do-it-yourself investor, do it better. We have on our website over 700 podcasts and videos and articles, all designed to try to help you understand this process. Now, there's a challenge in this process. There's a challenge because there are literally hundreds of thousands of people, if not millions of people, who want you to do something else. With, of course, the sales pitch being that if you follow them, you'll do better. Now, I must remind you that in life, when people are trying to convince us of something, whether it's a sales pitch or it's educational, whatever bias we come with, the intent is to try to help you believe what we believe. And I've always viewed this as one of the very difficult times in life because there is the courtship, and the courtship is the period where we tell people how great it's going to be. On the other hand, following the courtship then is the honeymoon. There's what actually happens after you've been courted. But then there is the reality. And the reality very often in life does not look like the sales pitch or what we were taught. It's like we learned a whole new history when we became 50 and above compared to the history we learned when we were 12. So our job, as we see it, and it's not just my work, it's the work of Chris Pedersen and Daryl Balls, and it's the work of all the people that I call the truth tellers who are trying to share information with you that they think and I think is trustworthy. Now, by the way, that's trustworthy about the unknown, and we can't know. So there's only so trustworthy it can be. But I do believe this, that if somebody who is really looking for a reasonable and a strategy that feels comfortable, that you need to know the whole picture. You need to know what it's like in the good times. You need to know what it's like in the bad times. Because we need to take you as best we can to the reality of investing. And this particular series, and this is the first of a series of videos that will go along with a series of articles, that will go along with a series of podcasts. And I wish they were all ready to go all at one time. It's going to take us several months to finish this series. And at the end of that series, I believe you will know about 12 of the most important aspects of investing. And I start with the one that I consider to be the easiest of all, the most obvious of all, that is likely to pay you a huge premium over a lifetime of investing. And so in this first video, and we've already done the podcast and we've already done the article and the tables are up, I'm going to walk through with you. And I can tell you, I wish I could sit down with you one at a time. Unfortunately, as I'm 80 years old now, I don't have time to do it. I've got to do it this way. A whole bunch of people, but I want you to think of it like I'm right there trying to walk you through these important pieces of information. And let me show you the first one here. And I want to see if I can get my pen working, if I might. Hang on here. Yep, I got it. So this is going to be my pointer, and boy, are you going to see a lot of important numbers with this pointer. But I first want to take on this topic of stocks versus bonds. And the reason that's such a big deal, I mean, literally, it is more important than the saving versus spending or saving early versus waiting till later. Whenever you get aboard, however you start saving, if in fact you choose equities or stocks over fixed income or bonds, I want you to get an idea of how big a decision that is. Because I truly think for many of you, particularly young investors, it is a multi-million-dollar decision. And I think you'll see it easily. The problem is, can you get over the emotional hurdles that come with taking the greater risk of investing in stocks than bonds? So let me start with a table that is focused purely on bonds. Bonds are simply a loan, an IOU. I loan money to a corporation, I loan money to the government, and they promise to pay me back. In some cases, in terms of what we call short-term bonds, bonds that may mature every month. You loan them money, they pay you back 30 days later. Very short term. I mean, as close to no risk as you could possibly come. First of all, it's a government guarantee. And secondly, they promise they're going to repay you in 30 days. What could go wrong? On the other hand, and by the way, I'm going to move forward so you can see these numbers more easily if you're on a cell phone by chance. So we talked about the short-term government bond. So there's virtually no risk and there's virtually no return. Now, it doesn't look like that because here you can see over the last 96 years, $100 grew to be worth over $2,000. And that's because the compound rate of return, money growing on money, leaving all the money there to grow and grow and grow, it grew at 3.3% a year. Now, what happened to that 3%? Well, a lot of it was lost to inflation. In other words, you lost the buying power. You were not doing well enough to keep up in many cases with even inflation. And then on top of that, potentially taxes. So when I say it's a no-win long-term proposition, I'm only saying that as safe as it may be and feel, that the insecurity comes with what it looks like over a long period of time. Now, if you go to loans or the IOU that's a longer term, like I want to borrow for 5 years, well, now interest rates can move up and down, and when they do, the underlying bond value moves down and up. So what do we know? If you went to a little riskier bond, still government guaranteed, instead of growing to 2,000 plus, it's 9,500. And the compound rate of return was 4.9%. And by the way, I want you to notice that with the very short-term instrument, the best one-year return was up 14.7, and the worst year was a little teeny tiny loss. On the other hand, when you move to the longer maturities, notice the best year was up 29.1, and the worst year was a loss of 9.4. And that was just a couple of years ago. Something most people were not expecting because they hadn't seen it before during the last set of 96 years. When you looked at a 94-year period, you didn't see this, but now it's there because it just happened. But still, look at the long term. You made more than 4 times more. And by the time you go out to the very long-term government bonds, they have a lot of volatility on a short-term basis. You can see the worst year was a loss of 26.1%. That happened a couple of years ago. And the best year was up 40. But the compound rate of return was 5.2. So on a short-term basis, if you If you needed money to pay a bill in 30 days, you wouldn't want to put that money in the stock market or in a year. Or if you were saving for the down payment on a house in a year, you would want to keep it in something very short term. And when the US government says, I promise, so far they've made that payment. They've paid their debts, sometimes not so easily, but they have paid them. But I want you to see what happens when we go out 15 years, because our life is not about 1 year at a time. Really, it's about some pretty big chunks of time. I know, for example, somebody who might put money in the stock market for their Roth IRA when they're in their 20s, they may leave it alone and not touch it for 40 years. But they're going to judge it along the way. And I want you to get an expectation of what that judgment the outcome might look like. So here's what I see, that over 15-year periods, and there were 82 of them, the best compound rate of return over 15 years was 8.3%, and the worst was a gain of 0.2% a year. Now, I can tell you, you're thinking, whoa, I'd like to get 8.3%. But during that best 15-year, inflation was almost as much as it made, because it was during a period of very high inflation when these kinds of short-term instruments pay their highest return. But still, after inflation, not much left over. But you can notice that as you extended from short-term to intermediate to long-term, that the best compound rate of return was 8.3, 11.3, and 13.5. And yes, they're all bonds, or they're all government paper or securities, but they're very different in their characteristic. And I think this is important for you to see this. And the reason I think it's important to see this is because a lot of people forget, when they get into the equities, into the stock market, that they're going to face the same thing. There are very different kinds of stocks that have historically had different levels of risk and different levels of return. They don't all look alike, just like the bonds don't all look alike. But for many people, and this is a frightening number for a lot of young people who are counting on, by the way, they're not sure about Social Security. They're not sure about getting a pension. They're not sure whether their parents are going to have much left over for them, by the way, by the time they go through whatever assisted living they might need in the latter part of their life. They don't know. And yet, when they make investments, only about 30% of them want to have anything to do with stocks, but they love bonds. And I just want to say that while they can be loved over the short term, that when you compare them to the long-term risk, which you're going to see in a minute for stocks, to me, there's no comparison which is right. But 70% of young people are not willing to take the risk of the stock market. We'll talk a little bit about why that might be. But now I want to take you out to 40 years. Imagine somebody had $100 and they invested it for 40 years. And that range of return was anywhere from an average of $565, about 5 times, to almost 1,000, to about the same, 979, 964. Interesting, by the way, here. This is a very interesting number. Notice over the long-term government bonds, they're more risky, they're more volatile, but they make about the same return over the long term as the intermediate term bonds. So one of the reasons when we encourage people to own bonds, and we'll talk about that in a future segment, under our boot camp, there is a time to own bonds. I'm 80, I'm half in bonds, half in stocks. I don't want to take a lot of risk. I want some, but I don't want a lot. But many of you are in the accumulation stage where you do want to take advantage of higher rates of return. And the question will come, will they have come at higher risk? Well, certainly in the short term, they have. And by the way, notice while the average compound rate of return for short-term government bonds, the T-bills actually was 4.4. The range was from 1.6 to 6.1. When you looked at the intermediate, it's from 2.8 to 8.1. When you look at the long term, it's 2.3 to 9.7. None of these have been home runs because those higher returns have almost, well, they've always come during periods of high inflation. So then, when we leave the world of fixed income and IOUs and loans and guarantees, and those guarantees can come from corporations, but the corporations don't always pay their debts. Just to know that, that's the reason corporate bonds have historically made more than government bonds, because they are more risky. Sometimes they cannot meet their responsibility and they go bankrupt. But at the other end of the spectrum is the stock, the ownership of a share of a company. That company doesn't promise you anything. What they do is they tell you they will come to work, they will do their job, they will try to make the company profitable, they will try to grow the company, they will try to make the company a good, socially responsible, some will say that. We're going to do for the good of our society. Other people don't care about so much about the good of society. They care about maximizing profits, and that's it. But those corporations are not guaranteeing you anything. They'll do their best. And by the way, many of them have had amazing histories of success. But we have to know that about half of the companies over a long period of time do not survive. They either go bankrupt or they get merged away into another company. And something very interesting about these stocks. Dr. Bessembinder out of the University of Arizona did a study along with some other academics, and they looked at the returns of all the public companies since 1928 or 27. And they looked at the returns. And as they reported, about half of the companies didn't make it. But while they didn't make it, the other companies were doing better and making up for the ones that didn't make it, so that the return for the group was very fine. But more interestingly, they found that about 4 out of every 100 companies, 4%, were driving most of the return of the market. The problem is, nobody knew what those companies were going to be ahead of time. And if they had, they would have simply invested in those 4 out of 100. And what the academics have told us, and a lot of people don't want to believe this, that if you own all companies, you are likely to get a better rate of return than if you try to cherry pick what you think are going to be the great companies for the future. That when you own them all, you are guaranteed to own the 4%. And by the way, then you're also in essence guaranteed to own the losers. But what I'm about to share with you are the returns of, in essence, kind of the whole. Now, just like there's short-term bonds and intermediate and long, and there's corporate and there's high grade and high yield, I mean, there's US, there's international, there are all sorts of bonds. And there are all sorts of stocks, of equities. And we call those asset classes. And so we like to look at the returns of those asset classes as a group. And in this study that I'm going to share with you, we have the ability, because of the academic research, to be able to look at the returns of four very major important groups of equity asset classes. And so I'm going to go through a review of those returns, both on a short-term and long-term basis. Now, when I say short-term, I can tell you that if you put $100 into the LCB, large cap blend, that is, in essence, the S&P 500, 500 large companies. Why do they call it a blend? Blend of what? A blend of growth companies, of very successful companies, popular companies, companies that have an amazing future. And then they also own what we would call value companies. These are not necessarily exciting companies, but they manufacture products we use every day. I mean, think of companies like Johnson and Johnson. I mean, we use a lot of their products. They're not known as being high-powered growth companies. They're more of a value-oriented company. But they're both in the S&P 500. And theoretically, if you want to think about what kinds of companies are in that particular group, that asset class, they're all very large. Some, by the way, are worth $1 trillion. How do they become worth $1 trillion? How do you know they're worth $1 trillion? Excuse me, you multiply the price of a share of stock that they have times the number of shares they have. That is the value that is being put on that company. So that if somebody had $1 trillion, they could go theoretically buy all the stock. Well, it isn't quite that easy, because a lot of people, millions of people, are going to own that stock. And many of them have no interest in selling. They want to hold it for the long term. The beauty is about these companies, if you decide today you want to get out of it, you don't have to worry about things you have to when you want to sell a house, for example, all the stuff you have to do. Now, when you got a share of a company, you just sell it on the open market. It's very simple, very simple. And by the way, almost no commission anymore to buy and sell the individual shares. But in looking for the reality, it is my belief that the best information I could bring to you, and I didn't create any of this. There is not one thing that I teach. I mean, I am a teacher. I am not an academic studying the history of investing. I am a teacher. And as your teacher, what I have found from the people I trust is the following. Here, over the last 96 years, based on one-year returns over the period 1928 to 2023, when I look at this group of stocks, big companies, successful companies, maybe some struggling companies, but big companies, the compound rate of return has been 10% a year. And $100 grew to $950,000. Now, that's pretty amazing. By the way, with a 10% compound rate of return, you double your money about every 7 years. Unfortunately, as you probably know, the market doesn't go up 10% a year for short periods of time. As a matter of fact, from 2000 to 2009, it lost about 1% a year, okay? And that was after for 25 years, it had made 17.2% a year. So there is nobody who can tell you, when am I going to get this 10%? But we do know that if you looked at holding it for the entire period, that you would have had a wild ride. You would have had a year you were down 43%. Now, in between years, there were many times it was down 50%, even more than 43. But if we look at the calendar years, that's the worst calendar year, and the best was a gain of 54. And for those who care, the volatility rating, the standard deviation was 19.8. Now, what you'll see is that when that number is higher, there's typically higher volatility and more risk. But compared to the bonds, I mean, think about the bonds. Down 43? No. Up 54? No. Now, what's interesting, and this is what the academics teach us, and you can choose to believe their sales pitch, or you can choose to believe the sales pitch from Wall Street. But what we know is if you look at, instead of combination of growth and value, if you took out the good companies and you were just left with the less exciting companies, it turns out, because as a group, they are more risky. Those companies compounded not at 10%, but at 11. And the $100 would have grown to $2.3 million instead of a 950,000. But the standard deviation, the volatility was higher. And in fact, you had one year that was up 92.5, and you had a year that was down 61.1. We are not interested in what happens in a year when it comes to our long-term investments. You don't worry about the price of your house 1 year at a time. Well, you might. As a matter of fact, we don't want our house to go up in value because we have to pay more taxes. But just like houses, don't go up at some set rate, there are bad times and there are good times. And what they tell us is over a long period of time, housing is about a 5% compound rate of return. Not so dissimilar, by the way, to those bonds, which, by the way, were kind of the same return as inflation. So the value of houses have tended to go up at what is typically a small premium over inflation. Notice that the volatility is higher. The worst case year was higher. The return was higher. What you had at the end of that period of time. Now, you see, none of you are thinking 96 years, I'm going to guess. But when my wife and I, and by the way, I will have one of these boot camp pieces is going to be about what we can do for our kids and our grandkids. I hope you join me on that. But we gave some money to our new granddaughter about 1.5 years ago. And that money could, in fact, be all equities, all of her life. And she could live to be over 100. So to her, these are real numbers potentially. Okay. Oh, and I should say something here that's important. Going back to 1928 means, hey, this includes the Depression. This includes world wars or wars. This includes all sorts of huge inflation periods and I mean, good and bad times, economics and politically. I mean, there's just so many forces, good and bad things that happened. But this is what came out the other end. At that end. Oh, by the way, if you go to smaller companies and instead of these bigger companies, on average, are going to be probably around 100 billion or more. These companies are more like $3 to $6 billion. Smaller companies, they have made more money, 11.9. That 11.9 compound rate of return took the $100 to almost $5 million. And you had a year it was up 111 and a year it was down 48. And it's a combination of little companies that are blended of growth and value, just like the large companies. So, can it get better? Well, according to the academics, it can get better. And according to that history of returns, look at small cap value. Get rid of the hotshot small companies and just own those companies that are, I'm going to call them out of favor. People aren't willing to pay much for their earnings. But the premium for having taken that risk, and the academics ask me to tell you, I mean, this is something they ask that people understand, is they would never recommend these companies one at a time, but only as a group, so that over a period of time, you're likely to get the premium. Because what they tell us from their studies, if you look at any 5-year period and you look at the companies that were out of favor 5 years ago, and you looked at 100 of them, 5 years from now, 50 of them are still going to be dogs. It's the other 50% that have made the big premium what it is. And they have no way to know which of those companies are going to come out the winners. This is one of the reasons, and one of the presentations that I'll make during boot camp is I'll try to convince you to own, in essence, all of the companies within these asset classes. And now the $100 grows to almost 15 million. Now there are no taxes here. There's no management fees here. But today, the management fees for these kinds of groups of stocks are 1/10 of 1% a year. Some a little more, some less, some free, actually. So now that's 1 year at a time. But because we know that we don't want people to own these based on performance for 1 year, we do want to see what it looks like when we go out 15 years. And we've got 82 of those 15-year periods. And what we see is that the compound rate of return for large cap blend on average for all of the 15-year periods was 10.7%. Now, wait a minute. What happened? Why was the return 10% before? Why would the return go up to 10.7? That's a big deal. That produces a whole bunch more money over a long period of time. But here's why. When we start looking at shorter periods of time, that period from 1929, for example, to 1932, it was catastrophic for a lot of people. And once you get by that 15-year period, because we're looking at 15-year periods, once you get by that 15-year period, you didn't ever have to face that same kind of huge decline. Now, you faced a